Assalamu alaikum. This is lecture 39 of Advanced Cost and Management Accounting. We are discussing the topic of inventory control by use of quantitative methods. So far, we have talked about the economic order quantity, EOQ, and we have seen how the cost of inventory can be optimized by calculating an appropriate and an optimum order size. So every time the inventory has to be purchased, the purchase is of a particular order size, the quantity that has to be ordered every time, and that quantity is going to affect the overall cost of managing inventory. Two costs we have examined, the holding cost and the holding cost as well as the ordering cost. Now, we have seen that these two costs can be minimized by changing the order size. This means we are looking at the variable cost elements. So we are not looking at the fixed cost elements because, as we know, fixed cost is something which will not change as the size of inventory or the size of order changes. So the variable costs are going to change. Those costs can be optimized by using the EOQ. One other method we are going to discuss is the classification of stocks, the control of stocks through classification. Now, classification we understand in many ordinary everyday uses. One common example of classes we are all aware of is the environment of the school, where all the students are grouped into different classes according to their age and progression through the classes, and then they move from one class to the next. So the whole school is organized in different classes. So you have class 5th, you have class 6th, class 7th, 8th, 9th, and so on. So these are classes in which students have been grouped. Now, this is a way of classifying students. We are going to now talk about the classification of inventory. Inventory is going to also be classified. Another example of classification commonly seen of inventory is the case of a supermarket. When you walk into a large supermarket, there are different aisles and different rows of stocks and inventory and goods of different types. Very often in the larger markets, they will give a name to a category of stocks. So for example, toiletries can be one section. Household items can be another section, and so on. Different types of sections you can find in the supermarkets. You can find that there is going to be confectionery and cereal in one section, meat in one section, bakery and those kind of goods. So the whole supermarket has been classified into different types of goods. This is a classification. We are trying to understand how to classify. So now when we look at inventory, inventory can also be classified into various groups. And we'll see how. Control of stocks through classification. Large firms may have thousands of items to be stored. It is not possible to apply EOQ to all. In a large business environment, we have already said inventory can be the single largest asset on the balance sheet of any organization. So where you have a large inventory, there you can have thousands of items in inventory. Now, it would be impractical to start identifying the ordering cost, the holding cost of each item, and then to use the demand and the formula and to find the optimal batch size or the optimal order size for each items of thousands of items in inventory. So that is the impractical position, and therefore other methods and other techniques are used. Stocks should be classified and elaborate techniques applied to important categories. A common procedure is the ABC classification. So some kind of classification will be required in stocks and inventory, and some kind of a procedure will need to be adopted in order to control A, the size, and B, the cost. Of course, the cost is the important aspect we are considering, and our aim is to minimize the cost of holding and ordering inventory. One method we have just mentioned is called the ABC classification. We are going to see in a minute what this means, how this ABC classification works. This is essentially making three groups of your total inventory. The three groups can be called A, B, and C for convenience. Now, the order in which inventory can be listed will be according to the number of items expected to be used, multiplied by their cost per unit. So we will arrive at an estimated cost of each inventory item. When we list down all the inventory items, then we can put them in different categories. For example, we can say the top 10% of the items are going to be called classification A, and the next 20% can be called classification B. So that's 10% A, 20% B, and the remaining 70% can be classified as C. It has been found that in most organizations, a very large part of the cost can be allocated or is seen to arise from a small category of goods. So therefore, the top 30% will sometimes account for about 90% of the cost. So 30%. So we are saying if you have 1,000 items, then 300 items, the top 30%, is going to account for approximately 90% of the cost of those items in the year. So the remaining 70% will account for just 10% of the cost. So by classifying stock into A, B, and C according to the cost based on the quantity expected to be used and the unit price, we can identify a large part of the total cost to a small number, in other words, 30%. Very often, a rule has been used, and commonly it is called the 80-20 rule. It's nearly the same kind of thing. The 80-20 rule is also saying the same thing, that 80% of the value lies in 20% of the goods. So this is an application of the 80-20 rule, and therefore in stocks we are talking about application in three different categories. An estimate is made of the total purchase cost of each item of stock for the period. Sales forecast is the basis for estimating quantities. In making the classification, we have to arrive at the quantity of item that is going to be used in the year. Now, in estimating that, you have to use some kind of a basis. And the sales forecast for the year will form the basis for estimating the quantity of inventory to be used. We have discussed this earlier in our forecasting and budgeting lectures, that the basis of budgeting and planning is the sales forecasting or the sales budget. So the sales budget is an important estimate. It is an important budget because the rest of the companies or the enterprises' activities are going to be based on the quantities that are expected to be sold. So the sales becomes the basis. We have the usage in the year, multiply that by the unit price to get the cost of the inventory items. Each item is then grouped in decreasing order of annual purchase cost. After using the sales forecast as the basis, you can have a list of all the items with their quantities and their prices and therefore the cost. You can then list them in the order of the cost. So the highest cost comes first and then the next highest and so forth. So that you have at the top all the high costing items and at the bottom all the low costing items. And in this way you will have a list of items showing their costs. The top 10% of items in terms of annual purchase cost are included in category A. Once the list is there of all the items, quantities expected, prices, value, in the order of cost, you can take the top 10% of the items. So we said that if we have 1,000 items in store, then you will take the top 100. That's the 10%. Top 100, what is the cost? Calculate the cost, and that will be category A. So category A will contain the highest containing costs, and it will contain 10% of the number of items. Similarly, for categories B and C, you will do the same exercise, that you will take the next 20% of the items. In other words, in our example of 1,000 items, we will take the next 200 items and call that category B and see what is the cost of these 200 items. So A, 10%, 100 items, B, 20%, 200 items, this is 300, and the balance 70% or 700 items will go into class C. So the next 20% is B and the final 70% is C. We said if there are 10,000 items, the top 1,000 items in terms of annual purchase cost are A. In practice, it will be unnecessary to have elaborate controls on the 7,000 C items. The 7,000 items out of our 10,000, example of 10,000, represents 70% of the total inventory held. And in practice, you will find that this represents a small portion of the total cost. We referred to the 80-20 rule. 80% of the value is in 20% of the goods. Here you might find, therefore, that 70% of the items will account for approximately 10% of the cost. So this is a very large number of items, and they're all small cost items, so it won't be necessary to apply all your EOQ models and individual holding and ordering costs and trying to identify the best order size into all of these remaining 70% of the items. That can be managed and controlled by other means, as you will see, and detailed and elaborate control methods can be applied to categories A and B, where most of the cost and most of the value lies. Just to look at an illustration by way of an example, we will see how the items are categorized, grouped, and how they represent the value. This short example shows the item number in the first column, followed by the usage. This is expected usage, and this is based on the sales forecast. The sales forecast will determine how many goods are expected to be sold, and therefore what number of items of inventory are going to be used based on a correspondent production amount, and therefore the inventory amounts can be estimated. So the number one item for usage is 60,000, where the price is 1 and the purchase cost is 60,000. This is the highest cost. So the first column is item number, second is usage, the third is price, whatever is the price or the cost, and the fourth column represents the value of the purchase cost. We can see item number 1, 60,000 items are expected to be used, and the value or the cost is 60,000. In item number 2, we expect 20,000 items to be used. The price is 0.05 each, and the value or the purchase cost is 1,000. So you can see that we are looking at the total purchase cost. The purchase cost is 60,000, and that is item number 1. In item number 2, the purchase cost is 1,000. In item number 3, usage is 1,000, price is 0.1, and the purchase cost is 100. Similarly, in 4, 10,000 items, usage 0.02 is the price, so the cost is 200. Item 5, 100,000 is the usage, 0.01 is the price, and 1,000 is the purchase cost, and so on. And this last item listed here is item 6, 80,000 at a price of 2, which the purchase cost is 160,000. Once you have a list like this for all items, you can then group it so that the highest cost comes first. So the highest costing items are grouped together. Now if you look at stage 2 on the slide, here the top 10% of the items were grouped together, and from our example of 10,000, there will be 1,000 items there as 10%, and the cost estimated of those 10% is 730,000 out of a total of 1 million. So 73% of the total cost lies in 10% of the items. In class B, 2,000 items, 20% is what is class B, and there is 190,000 cost, which is 19%. So class A has 10% and 73% of the cost. Class B has 20% and 19% of the cost. And class C has 70% and only 8% of the cost. This illustration shows what we were discussing, how the top 30% will be classified as A and B, and how they can contain more than 90% of the cost. The bottom 70% are going to account for less than 10% of the total cost. So this is a method of control of inventory, that you identify the high costing items, you separate them into a separate class, and then for those items you can implement your controls, your EOQs, and calculate the cost, and the rest can be managed and controlled in different ways. Other factors influencing order quantity: shortage of future supplies. Future supplies may be restricted due to import problems or transport difficulties. In anticipation, a firm may overorder stocks to meet production needs. So far, we have been discussing what would be the optimal way in managing the order size to minimize cost. Now we are looking at some other factors that are going to influence the order quantity. And there are other factors in practical situations which are going to impact, and you will not always go for the optimum order size according to EOQ. One reason for that is there could be import restrictions, import problems. We can see that imports are done by where goods are coming in either by road or by rail or by ships, large containers containing goods crossing borders coming in, and goods are being brought in. We can see on the ports, transportation and ships, all the containers are being loaded and unloaded. Where they are being unloaded onto the ports, from there large containers will take them and distribute them to the rest of the country. So these goods are brought in from outside and from different countries. These are imports. Doesn't always have to be, you can say, by ship. It can be by air, and it can also be by road. So these imports are going to be subject to different regulations, and they are going to be subject to different controls. There could be foreign exchange restrictions, there could be duties, there could be other limitations and restrictions imposed. So if the company finds itself in a position where there is some kind of a restriction on import, or there are difficulties in transportation and being able to move the goods from the ports to where they are needed, to the factories, to different towns. Transportation, how would that be a difficulty? There could be transportation strikes, there could be petrol strikes, price hikes, and so forth. So in these situations, organizations will try to preempt and try to take measures to overcome this difficulty. And it might be necessary to have larger orders in advance. And you might want to bring larger orders, maintain higher inventory level than ordinarily and in normal circumstances. So this case would be factors which influence your order size. Your order size, you would normally expect that you will calculate the EOQ model, using EOQ model, the optimum order size, and make orders for the optimum order size to minimize the cost of holding and ordering. But there are factors which will influence this decision, and other factors such as we have said, the transport difficulties, the import difficulties, they might make it appropriate to have larger order size just to ensure continuity of operations. Another factor that will influence is future price increases. Supplier announces price increase at future date. Firm may buy in excess of requirement. One other factor that will influence the size of order and the quantity of order will be any expected future price increase. Where firms find that for their goods which they purchase, the supplier has announced a price increase. So at some point in the future, the price is going to increase. And if the company knows of this, has knowledge, then they will try to buy early and buy at the lower price, perhaps quantities more than their normal or optimum order size. So this is another factor that is going to influence the order size. This is the expected future increase in price. Obsolescence. Stocks may be subject to obsolescence due to changes in technology, fashion, perishable goods. Purchases of small quantities and low stock may be appropriate. The third factor which is going to influence the order size is the factor of obsolescence. Obsolescence means that goods will go either out of fashion, or they will be out of date, or they will develop some defects that they cannot be used. In defects, you will have seen that perishable goods means that they are easily destroyed, they have a short life, and our example of fruit and vegetable is of perishable goods. If you go to a fruit and vegetable market, you will see that they are identifying separately all the fruit and vegetable which is a few days old, but because it is a few days old, it rots, it loses its quality, it's no longer the same and does not have the same value, and the customers don't want to buy. So this is in a way obsolescence, that it has resulted in some waste. So this is one factor, obsolescence. In case of perishable goods, I said fruit and vegetable, there the matter is exaggerated because fruit has a very short life and it has to be consumed and the freshness has to be retained. So most fruit and vegetable have a very short life, and therefore nobody would like to hold very large stocks of fruit and vegetable, perhaps regardless of their EOQ model. The EOQ model might give a batch size where holding costs, etc., are going to be optimized, but obsolescence is another factor that has to be considered on top of the holding and ordering costs. The other reasons we said that can lead to obsolescence are technology. People would be hesitant to have very large inventories of fast changing items of technology. Examples are computers, examples are telephone cells, mobile cells. Because the technology is changing so fast that if you have large amounts of stock, then if technology changes, the customers will move to the newer products and to the newer models, and your items will lie idle in your inventory. So that's another factor. Technology obsolescence is another factor. Changes in technology will result in obsolescence. Obsolescence means that these items are going to lie in inventory and not be purchased, and therefore they will develop faults and you will not be able to sell them at the same price and recover the cost. One other example of obsolescence is fashion. Fashion also changes very fast. So people in the fashion industry would not like to have stocks that will extend and that will cover a period where the fashion might change. So for changes in fashion, they would like to maintain stocks at that level, even though they can be small stock levels, to ensure that they are not at the end left with items of stock which are unsold. Steps to reduce safety stocks. When demand is uncertain, safety stocks are likely to be high. We have talked about how a certain amount of safety stock needs to be maintained, and this covers the uncertain supply or demand situation, where you find that your normal consumption is of a certain quantity, usage per week, but it can vary suddenly. And if there is unexpected demand for it, so that if you were using 200 units per week, and you may find that at times can go up to 300 units per week. So the demand might increase. Therefore, you have to maintain a certain amount of safety stock to ensure you cover that period of high sudden demand. Many industries have now expressed that at these times the competition is such that value is very important to the customer, and the pricing is very important, and therefore organizations, you can say, can't afford that same luxury which perhaps they could do in earlier days, is to have large items and large quantities of stock of a large number of items. So they have to try to restrict that, but at the same time the safety stock has to be maintained. So this is a balance that safety stock must be maintained. At the same time, you don't overburden the inventory, over-invest in the inventory, and have a larger amount which is going to increase the cost. When safety stocks may be reduced as follows. New suppliers are identified who promise quicker and more reliable deliveries. Existing suppliers pressurized for faster deliveries. And thirdly, the lower the average delivery time, the lower will be the safety stock and the firm's investment in stocks. So this means that firms have to continue to be active and proactive to try to minimize the cost of this safety stock. Safety stock, we are saying, is that suddenly the demand goes up and you don't have the stock for it. So firms will try to identify new suppliers who are willing to deliver quickly and at short notice, and they are going to provide a better service. So this is all due to the high competition and high costs that are rising, and yet prices have to be maintained, and so the profit margins are being squeezed. Those are all the reasons for it. So in fact, companies have to be on the lookout. One thing they will try to do is identify the new suppliers. They will also put pressure on their existing suppliers. And pressure means that they will tell them that we will have to look for and go to other suppliers if you are unable to deliver quickly, and decrease your delivery time and decrease the order time requirement or the lead time. So pressurizing the existing suppliers, finding new suppliers, these are the kind of activities that organizations have to be involved in to try to minimize the safety stock cost. The lower that is going to be the amount of safety stock, the lower is going to be the cost. And the lower that is the delivery time, or what we have described as the lead time, from the time that you place the order and receive the goods, this is lead time. So the shorter the lead time, the lesser will be the cost, and the lesser will be the need to hold large inventories, and therefore lesser will be the cost of inventories. Performance reporting. Managers are likely to concentrate only on those variables that are measured. They will take action to improve their performance rating, even if not always in the best interest of the company. Now we are going to talk of another aspect that is going to affect the cost of inventory and affect the control of inventory. And this is performance measurement. The performance of the manager. Now, manager must be held accountable for the cost that is arising due to inventory. We are saying that usually managers will take steps and they will try to improve on those items and those aspects of operations for which they are held accountable and for which their performance is checked. Other items, if the performance is not checked, they might ignore or they will pay less attention to. And it might also be the case that they will focus primarily on their own performance agenda. In other words, they will try to improve their own performance, even if that means that within the overall context of the organization, that aspect is not in the interest of the organization or it adds to the overall cost. So we are saying that they will take actions which will impact their performance or show their good performance, even if that is not in the best interest of the entire organization. If annual holding costs are not allocated to managers, they may be induced to obtain larger order sizes. Consequently, less frequent production runs will occur. This will reduce annual cost charged to the manager. In judging the performance of managers and in seeing what they are responsible for, the holding cost of inventory should also be allocated to them. So we are saying that in case the holding cost is not allocated to them and they are not judged on that basis and their performance is not examined from that perspective, then they might be inclined to take decisions such as have large production runs. If they have large production runs, that means that each time the machines are run and the products are produced, they have a larger quantity being produced every time. So there will be lesser production runs. Just to explain, if you need 50,000 items in a year and you are going to do, let's say, 5 production runs of 10,000 items each, that is going to be 5 production runs, and therefore it is going to have the cost of 5 production runs. Now, if the optimum size was to have 10 production runs of 5,000 items each, then this case would be where the managers are keeping the production runs higher, and therefore the number of production runs is lower or less, and so the production run cost overall in the year is less. That is going to reflect in the performance of the manager, and he will be pleased and he will declare a good performance of keeping low cost. But this larger production run or the larger order size, as we said, production size, is going to result in larger holding cost. So therefore, that holding cost, unless that is reflected in the performance of the manager, it might be possible that he will take decisions which will not incorporate that cost, and the company will have to bear that cost. And therefore, that is not going to be in the interest of the company as a whole. This situation can be avoided by charging holding costs to the relevant manager. So in order to avoid the situation, the cost that is charged to the manager, if you only charge him the cost of the production runs, he will try to have as few production runs as possible. But if you also charge him with the holding cost of inventory, then he will try to balance it, and he will try to optimize the production run and the size of the production run. Materials Requirement Planning, MRP. In complex manufacturing environments, the demand for materials purchases is dependent on the volume of planned output of components and subcomponents. They include raw materials which have to be purchased. Materials requirement planning is a computerized approach for coordinating the planning of materials acquisition and production. Our discussion of inventory control is now going to extend to the MRP, or the Materials Requirement Planning. Now, given that this has a high cost to the company, this entire process is now available in computerized form. So you computerize the various factors of your production and the quantities that are required, and the basis is again the sales forecast. What quantities are required, what is the timing, what is the batch size, how often should the batch be run, and then if you have different products, then how to change over and what is the best time to change over, and so forth. So this entire program can be computerized. This process can all be computerized, and this is what is the MRP, or the Materials Requirements Planning. The computer system will generate what is the best option for your production. It is going to incorporate the acquisition of materials and the production of goods. What is the best time to buy which quantity of goods? And the whole thing can be coordinated, that goods are being bought at the time that they need to be produced, and they arrive in time so that they can go into the production run, and they are produced at the time when it is expected that they can be sold. So they should have customer orders at that time, so when goods are produced, they can be delivered. So the process is coordinated, and cost is therefore examined in a manner that can be minimized. Sometimes now these programs are going to include raw material that needs to be purchased. So the timing of the material that is to be purchased will be incorporated. The quantities, the order sizes will be calculated within the system. And also the production is going to be planned. What is the optimum production plan given the sales forecast? And if there are a number of different items, then how to have the setups and how to have the changes and what production runs to have for each product. And this is the entire MRP system. These days, this is computerized, and it gives an optimal computerized plan. The major feature of MRP is that it involves an estimation of the quantity and timing of finished goods, and then uses this to determine the requirements for components, subcomponents at each stage of production. This has now therefore become a very useful and therefore a very popular program and a very popular exercise, the MRP. The materials requirement is an important area for all firms and all organizations. This has become so important. Basically, the idea is again to take the forecasting, the sales forecasting, and based on that to identify the purchases of items and the production of components, and where appropriate of subcomponents. So at each stage of production, the plan will set out what should be the quantities produced, how much are needed, and how much are going to be needed for the sales forecast and the sales demand. This entire process has become popular. MRP systems are being used in most large organizations to optimize the cost, this important cost of inventory control. The aim of MRP is to generate a planned, coordinated schedule of materials requirement for a specified period of time. It takes into account scheduled receipts, projected target stock levels, and items allocated to production but not yet drawn. The MRP therefore becomes a coordination of the various requirements of materials for a specified time. In this, the time is also specified. That's an important aspect, that the timing is now specified. The plan is according to the time schedule, and it is according to the forecast that has been built. The materials requirements, component requirements, production requirements, they are all incorporated, and each stage of production, each component of production identified in terms of what is the need, how much should be produced, how much should be bought, what would be the inventory level. There could be projected inventory levels, and there could be the production run sizes. This is going to include, therefore, the time at which materials are received and the targeted or projected stock levels. So all basically elements of production are going to be incorporated into this plan, and it is going to give a detailed, comprehensive plan which can be used for production and trying to manage and control production and inventory. MRP and EOQ. The EOQ model can be used within the MRP systems to determine economic quantity sizes to be purchased. Care should be taken to ensure that assumption of EOQ model of constant demand applies broadly. So within this MRP system, where we are saying this is a complete and a complex and a well-coordinated plan of how your materials should be purchased and how the production should take place and of each product, you can incorporate within the system the EOQ model. So this means that the MRP is going to use the EOQ model for the purchase of items based on their holding cost, based on their ordering cost, based on their annual demand. And all those three aspects are going to be included, and it is going to determine what is the optimum order size. So within the MRP system of complete coordination, all the purchases can be done according to the EOQ model, the economic order quantity model, based on the requirements of the model. So purchases from outside of materials, don't forget, we will still incorporate our classification system, where the number of items is too large. Over there, it will be appropriate to classify and use the 80-20 rule, as we said, or the ABC classification, classify items according to their cost into A, B, and C, and use that data and that information within the overall MRP system. And not only the purchases, we are also going to be able to include the production runs and the production sizes, the optimum batch size. That will take the same information, and it is going to use the same kind of information necessary, the setup costs, annual demand, and the holding cost. And it is going to incorporate that model and incorporate that basis to calculate within the MRP what should be the batch sizes and what should be the number of runs. So the whole MRP system is going to incorporate the EOQ model. Care should be taken to ensure that assumption of EOQ model of constant demand applies broadly. Here we are saying that when we are using our EOQ model, we should see that the assumptions of the EOQ, which is that the demand will be constant, that the unit cost will be constant within that range, those factors apply. As long as they apply, they can be incorporated into the MRP and it can be used. That's all for this session. Thank you very much.